Admittedly, this is a bit of a clickbait title because the best robot stock for us may not be the best stock for somebody else. Every investor will define best in a different way depending on what their goals are. But where we're coming from here is that we've published more than 180 pieces over the years on robotics, startups, and publicly traded companies. And we've done a fair amount of due diligence around this space. And now we're looking for some more exposure. So we have a lot of experience to roll back on when we're looking at potentially a stock that might be the best. And today we're going to talk about 3 candidates that we've shortlisted. So we have a disruptive tech report that we publish and refresh every month for our paying subscribers. And in that report, there are 3 robot stocks that we like, one that we love, and that means that we're holding that stock in our own portfolio, and then some others that we think should be avoided. So today we want to talk about the 3 stocks that we like. And we started out by plugging this into the Ministry of Truth, best robot stock to invest in, because that will usually turn up some interesting results, and indeed it did. First result was an ad for some equity crowdfunding robot that makes pizza. Anything that relates to equity crowdfunding, you avoid like the plague, because when you purchase shares in a company that's not being traded anywhere, your shares are worthless until there's an exit event. And these companies aren't necessarily incented to have an exit event anytime soon. We've seen countless of people a number of people get stuck with shares of useless companies. Ask those individuals that invested in High Times how that's going for them. Second ad was a advertisement for iShares Robotics and AI ETF. We've covered that before. I'll put a link to that research piece in the description of this video. They now have 270 million in assets under management. It's still quite a small ETF. That's why they're advertising. And then we came across an article from a investor site, a common site where pundits will post articles, and this author talked about the portfolio of stocks that this particular site suggested, and then you get to the end of the research piece and he talks about not owning any. That's kind of like when the wealthy gentleman in the Bentley goes down to the bank to meet with his investment advisor, who's a freshly minted MBA who takes the train into work. So whenever you're taking advice from a pundit, it's always useful to know that they put their money where their mouth is, and that's what we do. So we're going to look today at 3 stocks. And before we get into that, I wanted to talk about our own robotics exposure. So we have a stock we've held for a while that has some exposure to industrial robots. It's kind of a skate to where the puck will be sort of thing. We previously held the Global X Robotics and AI ETF. We reviewed all robot ETFs out there, and honestly, Global X puts out some decent ETFs, not only in robotics, but also cybersecurity and a couple other themes. But we decided not to hold any ETFs. We want to have a portfolio of only stocks. ETF seems like a easy way out. So we sold off that position. And now we're looking for some more robotics exposure to fill one of the 4 free slots in our portfolio. So we have a limit of 40 stocks. We have 36. We'd like to fill one of those open slots with a robotics company. And the first place that we would look are in the stocks that we've shortlisted over the years. And the first one offers exposure to robot-enabled surgeries. You probably already guessed what it is. A market cap of around 74 billion. It's fairly large, trading near 52-week lows. Aren't most tech stocks. And it has a simple valuation ratio of 12. It still seems a little bit high, and we'll show you why in a second. Between 2012 and 2018, robotic surgery procedures increased as a percentage of all surgeries from 1.8% to 15%. So there's a decent amount of activity there. Intuitive Surgical, that's the company, they're considered market leader with around 80% market share. And they had $5.7 billion in revenues last year, with a total addressable market that's expected to reach $10 billion in 2023. And that's been growing at a compound annual growth rate of around 16%. Now, when it comes to competition, one of the things we really like about Intuitive Surgical is that they're a market leader. Anytime you have a market leader, that's tough to unseat them. So when we look at the competition, we see, and this is some older data, this is from 2018, but this report is so good. we couldn't find a substitute to it, and the information is very useful. So this shows us really the competition that Intuitive Surgical faces. And in the lead position there is Stryker, and in third place is Medtronic with their acquisition of Maser. Now, we hold Stryker and Medtronic as part of our dividend growth investing strategy. So that means about 3.5% of all the assets we have under management are already exposed to medical devices. So if we invested in Intuitive Surgical, we'd increase that medical device exposure. And the question is, do we want to do that? Well, the other thing is that in our tech portfolio, life sciences is one of the highest categories of exposure that we have right now. It's 15% of the stocks in that portfolio. That's more than double our target weighting of 8%. So we're not entirely sure we want to start adding more life sciences exposure, even though you might put this under robotics. It really has more to do with life sciences in terms of the exposure it provides. So when the Rona hit and a lot of elective surgical procedures were postponed, Intuitive Surgical took a hit there. So the question is, do we want to purchase more life sciences exposure? And one of the largest stocks in our portfolio, third largest holding, is Illumina, and they're a life sciences firm. You can see here the similarities. So Illumina is about half the size of Intuitive. Both firms have around the same gross margin, and Illumina has slightly higher recurring revenues. Those are very strong numbers there. And Illumina is priced at a simple valuation ratio that's half of Intuitive Surgical. So if you were standing, looking in from the outside and deciding which one of these firms to go long, Illumina would probably be the one that you would pick just based on all the potential for genomics. So we're not entirely sure that ISRG would be a firm that we would go long, just because we don't want that added life sciences exposure. And we already have Medtronic and Stryker in our portfolio. Now, the next firm that we're going to look at, this slide is out of order. So we'll jump down here to a machine vision leader. So this was the cover of their 2014 annual report, and we couldn't help but just marvel at how fun this company looked to work at. And indeed, the average tenure of an employee there is 10 years. And when you reach 15 years, they send you to see one of the wonders of the world. And they did this big Ripley's Believe It or Not theme for their annual report. And that gentleman there in the top hat, he's actually an MIT professor who founded the company. It all looks rather interesting. It looks like a great place to work. That doesn't mean that it's a great company to invest in. So when we look at their basic financials, you can see here that in our report, we had noted that their revenue growth seemed to be on the decline, and that was before coronavirus. So we were concerned that they would continue to decline and then use the coronavirus as an excuse. Well, you can see that, in fact, in 2021, they've done quite well, and they've cleared $1 billion in revenue and resumed their growth. So this is a company involved in computer vision. They're a market leader in some niches. It's a $7.7 billion company, over 40 years old. They've paid a dividend now for 19 years, which we don't like growth companies that pay dividends. We'd rather they took that money and plowed it back into the company, but they've increased that dividend for 7 years. And logistics is the largest revenue segment in 2021 after growing 65% year over year. They have a simple valuation ratio of 8. That's after their share price has halved over the past rolling year. And they don't provide revenue segmentation, which is, it really makes it difficult to understand what you're investing in. And we listened to their last earnings call, and these are dreadful. It's a gentleman reading, seems like he's reading from a script for a half an hour. There's no slides. And he talks about, these vague statements around their different segments like electronics, and you can see the segments here. So you have factory automation, logistics, life sciences, electronics, automotive. They're not even all listed here. This is a different segmentation to compared to what the gentleman talked about in the last earnings call. And this is data taken from 2018. So it's difficult to say where they're at currently, but that's a big problem when a company doesn't segment revenue so you can see what niches are growing and what you're getting exposure to. So overall for Cognex, it's an appealing company. We like the fact that they're growing their computer vision offering. They have gross margins, upwards of 60%. That's very good for a hardware company, but it's there's just not enough visibility into what they're actually doing. It doesn't exist in their 10Q, their 10K, or their investor deck. So maybe they ought to have an investor relations team give this entire thing an overhaul. So we like Cognex, but probably wouldn't love it. And that brings us to warehouse robotics firm AutoStore. So we did a search just while doing the research for this piece. We did a search for AutoStore investor relations, and this is hilarious. So the search returned, the first result was an ad by Ocado Group. So if you're familiar at all with AutoStore, they've been in a legal battle with Ocado Group. That's a firm we used to hold in our portfolio until we sold it a while back because they had too much UK grocery exposure. And they've been battling Ocado in courts. And Ocado here you can see is running an ad for people, for investors in AutoStore, telling them that they're victorious. This is a pissing contest, and it's both sides are guilty. And I recall we've written a number of pieces on this. I'll put a link to the last piece where we specifically covered this, but it was something like, and I may mix up the names, but I think AutoStore came to visit Ocado and checked out one of their factories, and then they claimed that they were taking notes and copying things. It's just really ugly. So AutoStore and Ocado have been in this pissing contest, and you can see here, this is a list of what's called automated storage and retrieval systems. This is the market which is served by 4 solutions. You can see these: Cubic Storage, Shuttle, and the other 2. And on the left-hand side, you can see that for Cubic Storage, AutoStore and Ocado are the primary players in this fastest growing segment. And we were really attracted to that. And AutoStore never used to be public, but then they did go public and they were too richly valued at that time. But now it's possible to purchase shares in AutoStore using Interactive Brokers. So this is certainly a company that's very appealing. And look how diversified this firm is across different end markets. Wow, eh? So you have what retail and grocery, there's only 10%, and that's primarily what they're going in the courts, what they're debating in the courts with Ocado. So if they lose and they claim that they don't have a lot of downside, even if in the worst case scenario, but that's their exposure to grocery, and that's mainly the source of the spat. But look at all these other areas that they're operating in. When it comes to revenues, wow, look at this great revenue growth from AutoStore. The numbers are just awesome. And you have annualized revenues of 492 million on a market cap of 5.3 billion. That puts the simple valuation ratio at 11. It's a lot lower than it was at their IPO, which was 33, and it's really reasonable. Ideally, we'd like to see it in single digits like most other tech stocks, but they have gross margins of 63%. And as you can see, a small profit of around 22 million. That's after spending 10 million battling Ocado in Q1 2022. You can see here how they've managed to start becoming profitable, at least for the last 2 quarters. That's great because they only have $80 in cash on hand. That was another concern we had. So when they had their IPO, they used that money to retire some debt. Well, if they need to raise more capital, it's either diluting existing shareholders or increasing their debt. Neither of those scenarios sound very appealing. So it's good to see that they're becoming profitable. And as we've said before, we really hope that they bury the hatchet with Ocado and just put this behind them. Even Ocado said that that's what should happen. But of course, Ocado is attacking them still, and they're still battling each other in at least 3 different countries. So the next milestone is this UK court decision expected this quarter. So we're already in Q3 2022. And in 5 weeks, they have a half-year report. So our thought is that if we can see the results of that decision, really, the decision doesn't matter so much as not having that uncertainty. So once they have some of this uncertainty cleared up, then will feel a lot better, and this half-year report will be useful as well. And then this is really, out of the 3 stocks we've talked about today, probably the most compelling. And you can see here what AutoStore said. If we're to trust their management team, they say, at the current stage of proceedings, AutoStore has small downside risk from unfavorable decisions. And they say, including in part by strengthening innovation and patent filing strategies. Well, let's hope so, right? Let's hope that this gets cleared up, and that, in the worst case scenario, maybe they'll owe some basis points to Ocado for, work they're doing in grocery. So just to conclude here, we need more robotics exposure in our own portfolio because we find that theme to be quite attractive. We've talked today about 3 shortlisted candidates, all of which have some shortcomings. But we want to make sure we haven't missed anything. So we've looked at all the Japanese robotics stocks, and none of those are compelling, mainly because Japanese firms are very difficult to follow and to analyze. And if you're going to get exposure to Japanese robotics, you're probably better off with an ETF. And we've looked at some of the SPACs that have come out. Actually, there's one that we're going to probably take a look at in the coming days. But here's a question for everyone on the call here. What's your favorite robot stock you think we ought to be looking at? So just put that in the comments section and we'll take a look. Subscribe to our channel. Thanks so much for taking the time to listen to this video today. Now, here's a little Easter egg for anyone that actually made it to the end, because most people tune out when they hear us finishing off the call. But that robot stock that we're holding is Teradyne. That's the stock in our portfolio. So don't say anything about that in the comments. Keep it to yourself. But for those who listen to the very end, there's a little treat for you. Thanks for your time.